Okay, so my job is to introduce Dean Karlan, and normally when I do this for a keynote speaker, I just say, here's Dean. But today I want to spend a little bit more time telling you about Dean. I met Dean when he was a graduate student and has followed his career ever since. And I have to say it's quite a remarkable career, and that's why we're so pleased to have him. Dean is first and foremost a frontier scientist, a distinguished academic who was at Princeton, Yale, now at Northwestern, and has made major contributions to a number of areas. Two papers or two contributions that I have followed and have affected my own work have been one where he developed a method to sort out the importance of moral hazard and adverse selection in financial markets, especially in low and middle income countries. And that paper contributed to really important economic debates. And the fact that he and his co-author could find empirical evidence that was credible was a major contribution. And so that's contribution to science. A second paper I really admire is one where he and a bunch of co-authors were determined to lower poverty. And in that, they developed a multifaceted intervention which combined a lot of individual things we know worked or didn't work by themselves into this large, complex program, which they tried and showed successfully lowered poverty in the short term and the long term. And those types of models have been picked up by governments and international aid agencies. And so this body of research affected policy in a big way and improved the lives of people living in poverty in those countries. So both in science and policy, Dean has made major contributions. Another area which I benefited from and am grateful is Dean was the founder of an organization that provided research infrastructure throughout the world, Innovations for Poverty Action. And so a lot of the people who are reporting randomized controlled trials or field trials have partnered with IPA to implement those, to work with governments to make sure the interventions are implemented as designed, and then advise governments as to how to scale those policies that work. And then both the science, the policy, and the management expertise have taken him from academia to a policy job being chief economist for USAID. And I have to say, very few of us step out of our world where we're writing important papers that dozens of people read into a world where we're actually into a job in which we're actually trying to make the world better. These are not natural roles for us because we're used to speaking our minds and getting hammered for it. But they're important roles that I wish more of us would take. And Dean moved into an organization which is well known for being dysfunctional and is making it more functional. So as someone who's followed Dean and in his profession, I'm extremely proud of the role that he's taken on in policy. So I'm happy in that. I'm happy to call him my friend. I'm thrilled that we could divert his plane from Rome to Kathmandu so he could make a brief stop here and tell us what he thinks about the world. Thanks, Dean. Go ahead.
Thanks, Paul. And thanks for the super generous introduction. Oh, while you're doing that, I have three things I want to came to mind to reflect on. Paul left out first is excuse me. Paul left out a little bit of the story about how we met. So I was a second year or third year in grad school, and I had never met, I'd never been on like the the schedule that we do when seminar speakers come, right? And my advisor, Esther, I was actually her first student, said to me, "Hey, this guy, Paul Gertler's coming." I mean, I knew who he was, but you should get on his schedule. So I was a little nervous, like, what does that mean? Like, what do I do? What do I have to, do I have to prepare? What do I have to, like, how's that going to play out? And she's like, no, he'll just come in and he'll say, tell me about your work. And that's your time to talk with him about what you're thinking about. So I went in, but that's not what happened. Instead, he said, hey, I heard you're going down to Central America or Peru. I forget which one. I was doing both. When you're there, how about finding out the price of prostitutes with and without condoms? I'm thinking about trying to understand more about HIV and spreading and people's perceptions of risk. And this tells you a lot about perceptions of risk. And we can get this from, understanding the market. So I didn't do that. But as many of you may know, one of his fascinating paper in which he did do this in Mexico. The second comment is just a bit of reciprocity. I appreciate the comments and thoughts on the research, and the feeling is obviously mutual across many different areas, across health and financial inclusion. A lot of the work here is very exciting, and I've been enjoying following and learning from you for as long as I've been in this space. The one thing I want to correct. One of the most pleasant surprises that I've had at USAID is that it's not that dysfunctional. Yes, of course, there's some dysfunction, but one of the things that I think is exciting that we're actually seeing the needle move in many ways is how many people were inside the place, understand how it works, and we're totally enthused with the idea of making some of the shifts towards evidence-based grant making and award making that is part of why I joined. And so the biggest pleasant surprise has been actually the opposite of the dysfunction, where it's not to say everything was a well-oiled machinery following evidence in the way that we want it to be, but there's so much positive energy and bright people that are there that are just not in a system that allows them to make those changes. And so our biggest value added, for what it's worth institutionally, has just been showing up and then answering emails and receiving these kinds of welcoming advances from a lot of people as we are starting to make changes. Having said that, one last point before I get going, I am officially here not as USAID, so I assume we're not being like recorded or tweeted or anything like that, but if we're being tweeted, I don't care about that, but don't tweet me as saying something as USAID. I am here representing me or Northwestern. Okay, so I'm gonna share in the spirit of a keynote. I need a clock. You're the timekeeper. Okay. 2 minutes. Good. So let me just jump into it. In the big picture, I'm going to try to leave everybody here with takeaways that are some inward looking for academia, some outward looking for policymakers, doers. Should I use this? Oh, I see. Okay. No. There we go. Okay. Why do we care? We care about access to finance for its own sake. Why care? Is that right? Hopefully we can all agree that is not right. This is literally a means to an end. We should not care about access to finance for its own sake. All we really care about is recognizing that inflows and outflows of people's lives, when I'm talking about inflows and outflows, I'm talking about money, do not naturally line up. And I mean this in two ways. Over time, so we have seasonal variation, we have life cycle, we have within month variation, we have durable good purchases. And then we have over risk. So we have income shocks, consumption shocks, can be both positive and negative. Can I get some water too? My coffee's excuse me. And finance is really all about helping people move money, either forward or backwards, and to and from risky states of the world. And in a kind of very simplistic way, that's what it's supposed to do. And then the premise is, when we succeed in doing that, thank you. we can avoid some of these deleterious consequences that happen when you don't have access to finance, like more volatile consumption than desirable, lower investment than optimal, and onward to all sorts of outcomes when you're subject to, when just that you cannot move money forward and backwards over time and to and from risky states of the world. Why is it hard to, why is it that we struggle in this space as researchers? There's lots of reasons, I'm sure, but here's two, I think, that are kind of some of the challenges that we face. One of which is still an issue, and the second, I think we might all agree that we've kind of figured out ways of dealing with, not always possible. The first is knowing what to measure. There's a challenge that, a lot of times finance is like pouring, I think of it as pouring water on a table. You just don't know which way it's going to fall off the table. Like if you took a jug and just poured it on top. And here you are trying to measure things like what's the consequences in someone's life from getting access to finance, and you don't know where it's going to go, right? And so I think there's a lot of instances where we might actually kind of be arguing that, finding false nulls. Because we say when there's 10% of people do it one way, 10% another. You have 10 different stories for how people are using money. And if all you're tracking is what's the impact on different outcomes, you see nothing go up in a sense because everybody's doing something different. Now, obviously there's other cases where that's not, you have a more clear, narrow theory of change that you can map to. But in a lot of the cases that we see in finance where we want to understand what's the impact on somebody's life from getting access to savings, access to credit, access to better payments. One of the fundamental problems is that because it's so versatile, it makes it a harder measurement challenge. The correlation causation point is something this room is well aware of. And microcredit I've always thought of as a perfect example of where the selection bias that is inherent in microcredit about choosing hardworking people who are trying to fight their way out of poverty, which was always the canonical story. It's kind of the correlation causation problem is literally just baked into the very intervention itself. And so this is like my favorite little image to kind of make this point of the challenge between correlation and causation. And, if you just track the red, you can get some data that's like perfectly correlated with the truck moving and yet not actually doing anything. And so it's not always so easy to know what to measure and how to do it. And this is why we all do either randomized trials or some other method. Okay, this is basically now my last slide, but I'm just going to bounce back and forth a bit. So I want to share 4 categories of thoughts. One is, what is right with financial inclusion? Where have we seen a lot of success and progress? What is wrong as I see it? I'll spend more time there because we are forward-looking. We're trying to make things better. We're not just trying to pat ourselves on the back. What is right with us academics, and also what is wrong with us academics? So what is right with financial inclusion? What we've seen radically change over the past 20 years, 40 years, innovation on costs, basically. We saw this in 2 phases. The early phase, we saw this in models of microcredit in a lot of cases. No digital, this is pre-digital. And we saw models starting with Grameen Bank and other groups like this, basically doing business process innovation that lowered the price of issuing loans. And some of this was maybe about lowering information asymmetries, but some of it was also just about lowering the administrative cost of reaching low-income households. They actually showed that it's actually profitable. And we saw the world have its first IPOs and public and private sector move in. And now the financial credit markets for the poor is largely dominated by for-profits. And that's largely a byproduct of this innovation on cost. With this, we see now, obviously with digital, we're seeing the cost go even further down in countless ways. Not as far down as I think we would all like as humanitarians, but we're still seeing it come way down. There's obviously platforms that are getting developed that make it even that much easier to innovate, integration with policy, and also learning a lot about networks and market externalities and seeing firms kind of hopefully, in some cases maybe exploit, but in some cases clearly also make people better off. Obviously, there's a regulatory issue there about monopolies. Like I said, I'm going to spend most of my time on the going forward. So what's wrong with financial inclusion? The first is I think we're still lacking a lot on innovation on human design, human-centered design, and really understanding what are the what are the cash flow needs? And are we matching cash flows is the simple point. This mouse is not, I need to be able to click. I want to hyperlink. There's no mouse. Oh, there it is. Thank you. I just didn't see it all the way over there. Okay. One of the, I had two unpleasant years when I first finished college doing investment banking. I learned two things from that experience. One was the whole point. I mean, I'm not saying I don't know exactly when I learned this, but it was made poignant to me in investment banking that the role of a bank is to match cash flows. You got investors that want to have certain timing in which they want to make investments. You got industry that wants to be getting access to capital, different points to make investments, and the role of the bank is to be that intermediary and basically manage to deliver to everybody the cash flows when and exactly they need them. The second thing I learned is I really didn't like investment banking. So the matching cash flows is still a fundamental problem we see. So I distinctly remember this from the first time I worked. I was 22 years old and I went to El Salvador working for a microcredit organization. This is right after my 2 years of investment banking. And they were really, they were telling me stories about what, we're lending to poor women to help them, and they might be investing in their farm, they might be doing something else. And they said the farm, and I was like, wait a second, but it's a 4-month loan, and you're requiring repayment starting week 1. How is this an agricultural loan? And they're like, oh yeah, well, they got other things away. And I'm just like, well, how is that? That's not matching cash flows, right? And they had some stories as to why they did this. It's discipline. It's easier for us to manage. You have one product for everybody. Homogeneity works. So they had their stories for why to do that. But, it was clear that it wasn't optimal for borrowers. And we're now seeing, we have not seen much innovation in that lending model. It's actually really striking how often microcredit still to this day is rigid. Even when we get into the digital space, we still see a fair amount of rigidity. Think about, what we all have access to is the simplest thing in the world, just lines of credit. We can borrow when we want and pay it back when we want, to a large extent, whether it's credit cards or home equities. Like that level of flexibility to just get the money when you want it and pay back when you have it is not something that the poor have. And that very simple product is actually like still very much lacking in the space. And the motivation for flexible lending is kind of deep. So we have, these are the, when we look at microcredit, traditionally we also do see limited but positive impact on average, fixed repayment starting right after disbursement, and then the borrowers have to adjust. They maybe borrow $100 and put $30 in their pocket immediately because they have to make the early repayment rate. So now they're really only borrowing $70, right? So their interest rate basically just got jacked up on them, even though the bank's not even recovering that interest revenue. So it's literally just burning interest in some way. So some of the questions I'm going to share with you results from one study. There's been a flurry of other studies, but this is definitely one of those cases where I think we're seeing a lot of different results in different contexts in different parts of the world, different types of product design, and we need to clearly understand more about how to deliver lending products that are actually flexible in the sense of allowing people to borrow when they want and what they do not want. So what we do here is first of all point out that flexibility can mean many different things. So it could mean about longer. So think about it as type of target is liquidity needs. Is it planned or unplanned? I'm often amazed how often people talk about shocks for like education spending. I'm like, that's not a shock, that's a known. So sometimes you have flows that come and go, but in terms of when you need them, but there's not a shock to it. It's a known thing. So longer repayment intervals might apply to both. A grace period at the start of a loan, that's probably only applying to planned liquidity. Skipping installment and extending a loan, that's exactly what I'm going to share with you in a moment, is we tested this in Colombia where people were given a pass, and with that pass, they could skip a month's payment, and then their loan would get extended by a month, so that they had 13 months instead of 12 to repay, and or they could accelerate and pay it within 12 if they wanted to. Skip an installment and pay within the original duration. or repayment schedules tailored to the income process ex ante. So we've seen some of this, for instance, when specifically on agriculture, we've seen some success now with loans that are tagged exactly to agriculture or to the dairy process of a cow and things like this. So this project is with Lasse Brun and Javi Genet, and we give people out this pass for a bad month. We do something that is basically what Paul was referring to in his intro, where we randomly offer people from the get-go, either the loan with flexibility or the loan without flexibility. But then we flip people who were, we do surprise some of the people who were not given the flexibility. And after they take out the loan, we then tell them, oh, there's this extra feature of flexibility. And here's how it works. We find no difference whatsoever. That was actually, I don't want to say hope, but it was definitely a leading hypothesis that the fear of default is something that makes people not want to repay. I'm sorry, I said that wrong. The fear of default makes people not want to borrow in the first place. And that there's a certain deep irony in that, is that that's like the dream client for a bank. That's someone who's not willing to take out your loan because they're so afraid of default. That's not a moral hazard story. If they default, it's because of a genuine shock in which they can't repay. Banks should be totally fine with that kind of risk. That you just get rid of with diversification. It's moral hazard they want to try to figure out how to get rid of. And that's a person who's not even borrowing because they're afraid of moral hazard, because they won't commit moral hazard. I'm saying that right? But yeah. So that's always striking, but we didn't find evidence. Yes, we were hoping that, like the theory of the fact that this was holding back. And this is definitely one of those cases where I like to think of myself as a little bit on the, we all, I think, like to think ourselves as Bayesian. So I haven't given up on that idea that there's a good contingent of people who are not being served, who would be served if they were being given a better lending product that gave them that flexibility. We do see a little bit of shift in investments, but this gets at one of the issues that I'm going to tag to later that I think is a weakness for us academics: measurement. Really struggle with whether to think of, when we see changes in investment, we want to know, is that taking on more risk or less risk? And all I can tell you really is that we see a shift in the types of investments people make. One of the striking things is we do see positive feedback, even though there was higher default, positive feedback, no higher likelihood that people borrowed again. The bank thought of this as a success because the default wasn't, it was delinquency. They did, they eventually got everything. But it was certainly not achieving the things we set out to achieve. So in a sense, I just set you up by saying, oh my God, we got to be more flexible. We got to do all things. And now I'm showing you some results that actually don't really support that. But this is why we need iteration, we need tinkering, and we need to work on this further, because there's no doubt that we still have this basic fundamental problem in the way that products are designed. So here I just want to expand a little bit about this measurement issue about expectations on investments. This is an area that I think of as really weak for the academics. So this is part of that first slide with the fourth item. There's a lot of situations where we take the multifaceted work that Paul was referring to, that is trying to get low-income households, providing them cash grants to start up productive assets and productive livelihoods. We spend a lot of time trying to understand how people are choosing what they choose. And part of that is understanding better what are the risks and returns to goats versus chicken versus shea butter versus the different options they have. And not just what are the different risks and returns, but what do they perceive the risks and returns to be, and how accurate are those perceptions? And then you add in a whole other layer of recognizing that the right answer is not, here's the risks and returns for goats, that it's going to be different for different people based on their capacity, their ability to, in terms of their human capital, their knowledge about goats, their time availability, all these things. So there's almost like this person-specific return. And so it's complicated. I don't mean to sound lazy, but it's complicated. And yet it's actually one of the pieces that we know that we need to understand much more, because when we want to think about how products or any sort of policy is shifting the ability for low-income households to get out of poverty traps, fundamentally, we have to understand what the choices are that they face for investments, how they perceive them, and what's holding them back from taking on those investments. Okay. Oh, I didn't put the hyperlink in. Let me see where that is. Oops. Okay, I'm just going to tell you this one. There's just one slide on the second example on credit that is striking is a lot of microcredit organizations talk about wanting to reach small, medium enterprise. I've heard this for years. How do we expand and identify people who can handle much larger loans, who can really help build the small, medium enterprise market more? And so we worked with a bank in Egypt. This is with Adam Osman and Garrett Bryan, that was basically posing that exact question. And they built in psychometric questions to their loan application moment and through a survey. And then a treatment group got loans that were 4 times as big. It was a selected sample of the people they thought were most able to absorb much larger loans to really accelerate their business. And the striking thing was that the average result was mildly positive, but the psychometric variables were very separating. Using machine learning algorithms, the people who we labeled over-optimistic, but I'm going to put a little asterisk on that for a moment, did much worse. People who were not over-optimistic did much better. And we saw this as a sign of taking on too much risk. Having said that, it goes right back to my last point. Like, I can't tell you, here's exactly the investments they made, and here's what we know about the risk and returns and things like this. I can just tell you that those are the people that did better versus worse. But just as expectations and beliefs about the returns on different investment opportunities, optimism too is something that if we see it driving, and these were questions that were things like, when I have problems, I immediately think of ways to solve them. I have high hopes for how I'm going. I'm sorry, I'm not good at remembering the way they were exactly phrased, but they're questions like that were statements and you agree or disagree. And the striking thing is, in some sense, how unsatisfied we should all be with those questions. And yet I don't have anything better, right? What does it really mean to be over-optimistic? Like, we need to know what's actually the true expected value for someone. Like, we do actually have different correct expectations. So just because you see someone high and other ones low, that doesn't mean they're overly optimistic. It just means they're more optimistic to someone else. So this is not an easy thing to do. And again, I don't mean to sound lazy, but this is an area that I think of as an area we need to understand more about, is how to understand something about when someone's expectations are far removed from what's realistic for them. So that's going to come in a moment, and I'm going to share some slides from some work that's not mine, that's Supreet's, in a moment. But that's also relevant. So why are these hard to do? I think is these kinds of studies on innovation in the lending to make them better products for low-income households. I think there's a couple constraints we see on the institution side, time and time again. One is investors pushing for too high of a repayment rate. I cannot tell you how many times I've been in a meeting where I have been given the fact that we got 100% of our money back or 99% of our money back as a good thing. It's like, this is a sign that we're working, we're doing a great job. Look, we got 100% repayment rates from our clients. I hear that, and I think that's exactly the prima facie evidence that you're not doing your job as a bank, as a lender, because that means you're not taking on any risk. You're not reaching out to people who have high risk, high return opportunities. You should be able to diversify across that in a world with no information asymmetries. That's a world in which you should have some default. You should be baking it into your interest rate. Wouldn't even change. I mean, realistically, if you think about where interest rates are, that's not default driven. So if defaults are 5% and interest rates are 70%, the 70% interest rate is baked in because of some transaction cost or excess profits. It's not baked in to cover default when you're seeing default rates at 0 to 10%. So, but why is that happening? That I don't have a magic answer for you other than to say there's clearly some sort of principal agent problem going on where someone doesn't trust someone to be like, no, it's okay, take on some risk. We want to see you push. We want to see you innovate. How do you manage as an investor to get, no, I want you to get exactly 5% default. Too much, more than that, that's bad. Any less is bad. I can see how it's a little bit of a problem from a management perspective, but we should see more default. And likewise, then we do need investors and donors to be pushing for exactly that innovation. Maybe it comes from guarantee funds that guarantee innovation. That's definitely a role a large donor could play. So The next area is on savings. One thing that's striking, first of all, on savings is, there's been a fair amount of work on different product designs. First, start off with a very basic, does access to savings product increase use? And the short answer is no. So we see lots of expansions of savings, just getting people bank accounts. And yes, that can do some good just straight up. But in like the Fintech in 2015, over 50% of account holders made no deposits in the accounts they had in the 12 months prior. Here's 3-country study that I did with Pascaline Dupont and John Robinson a while ago, and it just shows you very simply the take-up rates in 3 countries from giving away bank accounts, and then the usage rate. So why are some reasons people do not save? I'm going to go kind of quickly through this, not talk through every point because of time, but I want to share one kind of obvious point, which is one of the reasons it's not necessarily easy is we have this instinct to always assume people undersave, but it's hard to know what is the right level of savings. Like imagine a survey question where you say to someone, are you satisfied with your current level of savings? Would you like more savings? Or raise your hand if you wouldn't like more, right? So there's a great line from The Simpsons where Homer says to Montgomery Burns, you're the richest man I know. And Montgomery says, yeah, but I'd give it all up in a moment for just a little bit more. So it's not actually like establishing whether someone is under saving is not so obvious what that means and how to do it. It's easier to think about flaws that might be driving down savings, and then you can alleviate it and it moves it up. But I'm always a little bit nervous about whether we want to call that under saving or not. But there's a series of constraints, and I'm not going to talk through them all, that I think are useful to think through and then use these kinds of constraints: high transaction costs, behavioral constraints, social demands, lack of trust. And this should be like a shopping list for someone thinking about how to diagnose problems in a particular context and then roll out policy. Okay. I'm not going to talk about consumer protection, but it was important to me to put it on here because this is an important issue. But it could be a whole other lecture, and I want to just point out that when you talk about credit, you absolutely need to talk about consumer protection as well. So now let's talk about what's academics. What's right with us is, in a sense, thousand flowers bloom. Lots of creativity, exciting work. Lots of the papers presented here, like you put it all together, and it's fascinating what we learn from each individual piece. We're seeing theory-led innovation. We're seeing market-level analysis. We're seeing innovation on product designs. We're seeing integration of AI and machine learning. So what's wrong with us is also the same thing. It's the thousand flowers bloom problem. And so we don't have coordination on measurement. We don't have enough replication. So I'm going to talk about that now. And we also don't have enough overlay on fixed cost of research. So like a common platform over which you can use APIs to link up with mobile money and then roll out savings product designs. There's a lot of infrastructure-like things that could be built and could be invested in from donors that then lots of research could feed off of. And when you did that, if you were all feeding off of a similar system, you could learn a lot more because you can actually compare better across studies and have a better understanding of what's actually working. For something that's kind of in that zone, I would encourage you to look at what Angela Duckworth and Katie Milkman have built with Behavior Change for Good at Wharton. More domestic focused, I think entirely domestic focused as of now, but they have some models there of doing this kind of work. So let me just now share with you two thoughts on replication, which is something I just think we need tons more of. Yeah, I'm gonna go. I'm almost there. So I did some work early with Maggie McConnell, Sandal Munoz, and Jay-Z on reminders to save. This was so done. Now I'm feeling kind of old. This was 2 of these sites. There were no cell phones yet, so we actually sent letters reminding people to save. And it just, of course, assumed external validity. Letters to text messages, right? Who would ever think that doesn't hold? Decent large average effect, a fair amount of variation across the sites, but decent large average effect. Yeah, I would say from a policy perspective, there was more unanswered questions than answered. It was just And so, we didn't have long-term track. We had limited within study variation, no replication. So what next? So I have two ways that I think about how to go from that. And what's nice is that it's such a laser-like kind of simple thing. It's a message. How do you manage a message system in order to optimize and guide people towards decisions they themselves want to make? Two thoughts. One is to go global and the other is to go granular. What do I mean by this? For global, I mean much more N, like add in more sites, add in many more observations, a bit more X in the sense that we can create more variation across sites. But and I'm about to share with you 9 different text messaging studies that have been done around the world on reminding people to save. So some variation on what the treatments were, but just a much, 1.8 million people. The other is to go granular, and this is the work that that I refer to by Supreet, which is to say, no, let's just get much more precise about the X in a sense. And what I mean by that is much more precise about designing a very specific product for a very specific use that is, that really thinks through what's the theory of the problem we're facing, and then how do we design something that really nails that theory, right? You're sending text messages to 1.8 million people, you're not doing that. Right? You're just testing a bunch of average effects across a few different treatment arms. And maybe you're going to try to do some heterogeneity analysis with the machine learning to try to see if there's some patterns, which is what we're doing, but it's not at all that laser-like kind of theory driven. This trade-off between global and granular, and this kind of for external validity purposes, was exactly the point of a paper I wrote with Greg Fisher called the Catch-22 of external validity, in the sense that the going global is lacking in any sort of deep theory underlying and ignores heterogeneity in any sort of super thoughtful way, but has that kind of global sense of it was 1.8 million people and we found an average treatment effect, so that's great, just go do this. And so that's nice, but we don't have a good theory as to that really gives it that legs you want. Whereas when you go granular, you really nail a theory and you really understand it. But is that going to work for 1.8 million people? How do you scale? I think both have paths to doing that. Don't get me wrong. I'm not saying this in a deeply critical way of either. I'm just pointing out that these is 2 different ways of thinking about how to get external validity. So the going global, as I mentioned, we have 1.8 million unique individuals. So we have 17.5 million observations during the treatment process of getting messages, 17 million afterwards, 9 replication sites. Not going to go through the detail, but here's sites and each site had a little bit different mapping. I completely lost a side bet we had over when we set up this process and kind of designed these ideas and then set off a team to say, now go just get as many as you want. I think I predicted we would have 25 sites in 5 years and we had 9. So the p-values are crazy small because we have so much data. That doesn't always mean the treatment effects are big. But one main striking thing to point out is that a lot of times the results go away over time. So if you just look at the average result, I'm not going to go through all of these details, but where was I looking? Oh, these are the inactive. That's why. I was looking at the active, where we have the 8%. This is the people that were active in prior 8%, 8 percentage point improvement in likelihood of making any transaction, but then afterwards that drops down to 4%. The amount saved is much larger, but very noisy, and I'm not sure what to think about that. We were kind of struggling, but I think the heterogeneity analysis is going to help understand some of what's going on there. So the main thing I want to share, though, is this next slide, which is we don't find much to predict. Of all of the X's we did, we find very little is predicting. Look at this is all differential results to the average treatment effect. And so does it mention a goal or not? Doesn't really matter much. A little here on using the debit, making more withdrawals. Does the day of the week matter? No. Does timing it around payday matter? I thought that one was this one really surprised me. Time of day didn't seem to matter. And then the contents here, 5 different types of categorizations of what the content was saying. Was it intention? Was it trying to shift a behavior, like using like loss aversion, using some sort of behavioral idea like that? Information, was it persuasive? A few things here and there, but a lot of things are just lining up exactly at the average treatment effect. Let me skip this and then tell you about the going granular paper. So this is recent paper from Zambia that looks at basically the problem of people not saving enough for the hungry season. And, one of the ways that I have often motivated just reminders to save way back when was I would open up the seminar by saying, imagine I didn't show up today and you had to write down on a piece of paper why I didn't make it here. And we had two lists, one with 3 options and another, and the other with 2 options and another. And the point is that people always underestimate that other category. So if you give them 3 and other, you'll end up with a much smaller other. So the basic point is that people are, we can make better predictions about the future when we're thinking about a very well identified category. So if we're trying to name our future expenses, and if we're just told, name your future expenses, you're going to leave out a large chunk of other. If you go granular and you start asking about different chunks, you'll get a higher number. And so that's, in short, the exercise they ran. This just shows you how much people were overly optimistic about their ability to have money during the hungry season. So this is the expectation, right? This is the realization of how much they actually had in 3 months during the hungry season, and this was how much they expected to have, and they were way high. This was actually their worst case scenario expectation too. So they were even worse than their worst case scenario, right? So this just lays up like this is the problem, right? People are, even though the hungry season happens every year, this is not a shock, right? But yet you still ask someone, how bad is it going to be? And they overestimated, saying it backwards, they overestimated how much they would have. They underestimated how bad the shock would be. I'm sorry, I said that bad again. So it's not a shock. That's the point. They underestimated how bad they would be. So this was an exercise then that worked through with people that exact problem and helped them re-estimate and form a better estimate for what they needed and thus put money aside. And this shows you now the smoothing of consumption that happens as a byproduct of this treatment. So the control here and the treatment is getting smoother. How do you do this through digital at scale? I think is a huge question and is very exciting. That's an open area. So, and then, so then the last thought I want to leave you with, and then I'll truly have the one last thought, I guess, is there's a timing problem for us researchers, I think. A lot of times we have this weird knack for doing 1 year, 18 months, 2-year results. And when we first put out, for instance, a lot of the microcredit randomized trials in the early 2010s, I was struck by how many people who were not happy with the lack of big positives all said, oh, but maybe you're just not measuring long enough. What I was always struck by is we didn't know the short run answer. We didn't know what people actually did with the money because we often didn't measure for a year. And so you had a lot of things happen over that year. And you might see some changes in investments, but you don't know literally what the path was. And it was always striking to me how little we knew about what they did with money. We just did a meta-analysis of 85 randomized trials of cash transfers programs, and we have the same problem on that. It's not quite as bad. There's more, but even there, a lot of times we wait a year before we do any measurement. We need more short run, and we obviously need long run too. That's easy and more trivial, and very few people don't agree with that, but I don't hear enough push for the short run. It also would be faster. We would get more, we would learn more quickly. We'd be able to iterate more. We don't always, if we see the short run process change, investment goes up, we can design around tinkering to see investment go up. Let other research find out the impact of investment going up on profits. In the short run, let's just do more product design tests to find out how to improve investment flows. Okay, so what are the main to-dos? And I'm done. What I see is some of the big issues that I would like to see our world conquer on the investors, donors, doers, is really taking that double bottom line seriously, which means more product design that's human-centered and takes on risk. And it also means not losing focus on the poorest. Look at America. We could have had this conference be entirely about financial inclusion in the United States, and we would be talking about high prices and risk and mismatching and bad products and all these things, right? So this is not trivial, and we can't just say, oh, it's a bad market because it's a developing country. And the third is we do need to share results, good and bad, independently validated. And I know we're, that intersection with for-profit, and a lot of times that is more of a tension with for-profits than not, but it doesn't need to be. On researchers, I think we need more coordination on methods and measurement, in particular, more coordination on common platforms so that we can feed off of a common infrastructure and kind of holding all constant as much as possible, when then being able to compare intervention ideas and measurements and things like this. More sharing of data, more meta-analysis. It's really striking how little we do of it and how much value it has, and I say this now as someone who's, flip sides a little bit and wants to see more meta-analysis for the sake of setting policy. It is just so much more powerful when someone can, when we can walk into a room and have a conversation saying, here's the results of 17 studies, or even 6 studies made a big difference, having 6 altogether in the work Paul was referring to. Having 85 randomized trials on cash transfer, that shuts down a lot of conversations, particularly because the variance of outcomes, the variance of the treatment effects is so small. If the variance of treatment effects is huge, then obviously that's a call to arms to say we need more research. We need to understand better with that. But when you do a lot of iterations and you find very low variance in outcomes, that's, that needs to be done and shown as a meta-analysis. And then lastly, the short run, long run point I just made. So with that, I'll close. Thank you very much.
Hi. I'll confess I didn't listen to every word you said, but I think you didn't say behavioral economics. I'm just wondering, generally what the role of that as a science or field is in this type of work.
You're right, I didn't, but I did. A lot of what I was referring to fits very much in the space of behavioral economics. When we talk about attention, I mean, the work by Supreet is like spot on, something that I would, label in that way. The one thing about the term behavioral economics that I'm struck by at USA, for what it's worth, is that people seem to think of behavioral economics sometimes as only being about kind of, I don't want to say cute, but in some sense like, oh, if you just add this extra 3 words, then you get this different result. When in fact, the term behavior taken seriously is just behavior. Let's just be clear about what those 2 words mean, right? So like a study on the impact of microcredit is a study in behavioral science. Like that's behavior. We're trying to understand, you get credit, how's your behavior change? So everything I presented, I would call behavioral science. That's certainly the way I talk about it within USA, because the last thing I want is people thinking about doing impact evaluations only focusing on tiny little things that are about, time inconsistent preferences that are kind of one of the, the poster child of behavioral economics. So.
Yeah, so I was wondering, when you talk about like flexible payments, in our case, we ask our users, and some people said like they would rather pay like weekly because of the characteristics of the business that they have. And so we try different things, and like it was also by interviewing that people itself will say different stuff, and it will be very linked to the kind of business that they have. And in my mind, sometimes if it's like, well, if a 4-month loan and pay me whenever you want, then also sometimes for the informality, in my mind, maybe I'm wrong, and that's why I'm asking, is that you don't help the person have like a roadmap or a better plan, and then that makes things worse sometimes. So I was wondering, what do you think about that?
No, I think this is a great question, and I think this is exactly why I would say there's, I have ideas for how to tackle it. Will they work? I don't know, but I think about our own lives. Like in a sense, banks do that with us with credit cards. We repay. Right? They don't tell you when you have to repay, just a minimum. So if that was a situation, for instance, I would start by trying an interest-only model. Interest-only models, I think, are useful because it's just it's a little bit of money. Yes, it's not zero, but it sends the signal that, hey, we haven't, you're not off the hook. We still owe us money, but it's just a little bit. And quite frankly, if someone is willing to pay interest only forever to a bank, that's actually profitable for them. They don't like, why stop at 4 months? Like, why term it out? Why not just make it a line of credit? Let them pay whatever they want, whenever they want, as long as they pay the interest only. It works in rich countries. Why can't it work? So that's the kind of thing that we need to see more innovation to figure out how to get around that. But there are some things that I would say are from the behavioral economics too. We have a study, for instance, that showed send someone a message to encourage repayment from a loan, and it was much more effective at getting them to repay when the text message was signed by the credit officer versus not. Right. And so, how do you make that leap to, even in a digital space, to introducing a little bit of the human touch so that sentiment of reciprocity, that sentiment of relationship is still maintained. That might be necessary. But it's not going to be a simple little formula for how to do it. That iterative set of testing is exactly what I think digital platforms and digital lenders need to be doing. And there's tons of researchers that would be excited and thrilled to be part of an iterative process like that.
The organizer's prerogative of asking a dumb question. Now that you've been seduced to the dark side, one of the things, at least my time in a similar job was frustrating, was how strong beliefs about what works are ingrained in governments and policymakers. And despite evidence, we couldn't get in the World Bank people just to kill stupid ideas. I remember Stigler telling me the main job of the Council of Economic Advisors was to kill idiot suggestions coming out of Congress. And so have you run into this? And I understand what you're doing is trying to make USAID much more evidence-based. But how much resistance are you running into, and what do you think we can do about it?
So my short answer is that, there's willing and eager within USAID to do to kind of look at the evidence and let that guide. There's willing, and then there's the category you're talking about. And there's also some things that USAID does that are outside the space of, evidence, like the way we're talking about helping it. They're working on macro reforms and things, and there's enough of that first bin that I don't even know what the size of the last bin is. When we face that, so far, I luckily am able to just ignore it and say, fine, we won't work with you. We got enough over here. But that's also part of the strategy, is to think that that's about culture change and mindset shift. And so when we do work with them and we see changes happen and people are happy about those changes and they're excited and they're documented, then it shifts the willing into the willing and eager, and then hopefully it shifts that third bin into the willing. But you can't win them all. That's okay. It's a big place. So we have over demand for our time there's never been an office before of a chief economist. So this is I'm running a startup within USAID is the best way to describe it. Luckily, I have some awesome people that were able to join. I have a deputy, Ann Healy, that many people know here. Caitlin Tulloch, I just stole, who's over here too. And so some, amazing people that have come to help build this startup. And we'll get there. But, right now, because we're only 20 people, we're not having to deal with what you said. If that happens in a meeting, I just can get up and leave. I mean, not literally, but I can just be like, fine, I won't work on this. Let's go work where we're wanted.